Well, as you can see, the market is down, but bank stocks, they are not. In fact, they're rallying this morning. JP Morgan authorizing a new $30 billion buyback program. Joining us now is Tom Michaud. He's the CEO of KBW. That's the Stifel company. Tom, let's just start there on the buybacks. The big banks getting the permission to buy back a lot of potential stock, I would assume, is a positive. Are we going to see a trend here?
It's a very big positive. I mean, remember, the Fed didn't do one stress test this year. They did two. They came back and did an even more severe one than the severe one they had earlier in the year. We think it's really bullish, and it's happened about 6 months sooner than we expected. And I think it represents the fact that the banking industry has enough capital to get through this crisis. And our math suggests, and if our models are right, many banks can buy back 20% of their market cap at today's prices through the end of 2022. We think it's very significant.
Yeah, that would have a significant impact, of course, on earnings per share numbers. Do you think the big banks are better positioned than perhaps some of the mid-size, the regionals, or even the smaller banks in terms of doing that?
Absolutely. As a matter of fact, we think the earnings per share growth from the biggest banks is going to be about twice as fast as the smaller banks looking into 2021 and 2022. And just about every valuation figure that we look at has, especially on a relative basis, still has the banks about 20 to 25% cheaper than I think they ought to be.
Tom,
We're still positive.
Go ahead.
Yeah, no, we're positive. I think a year from now, these stocks will be higher than they are today, in my opinion.
You know, we're talking about bank buybacks, stock buybacks right now, at least for the largest banks on the one hand. On the other hand, you've got reports out there that there are tight lending conditions for small businesses, particularly in those industries that continue to be hardest hit by COVID. I realize there's a lot of nuance here and it's not an apples to oranges comparison, but when we do talk about things like income inequality, it does seem like there continues to be this divergence in terms of what the banks mean on Main Street versus what the banks mean on Wall Street.
So that's a really interesting question, because on Friday, the Fed came out with two pieces of information. One was the stress test. The other was the weekly H8 data. The H8 data said that the fourth quarter's loan growth is going to be the weakest fourth quarter since the end of 2009. There just isn't a lot of loan growth in the economy right now. But when you look at it, Morgan, you'll see that bank lending to consumers is actually the bright spot. The banks do have enough capital to make those loans. It's commercial businesses who haven't been asking for it. And it's because of a lot of the government stimulus that's been out there. It's been the favorable bond market that's been helping. And frankly, I think businesses have been pulling back due to the uncertainty. So that's the one piece for the overall industry that hasn't moved yet. But I think the banks have been working very hard to make sure that they have the capacity to lend for the loans that meet the criteria in the industry.
Hey, Tom, you know, for the last few months, the bull case has been in three parts. It's been buybacks, over-reserved, and curve steepens. I wonder how that last piece gets filled when expectations for 2021 are so tepid.
Yeah, so our view is that a 10-year that's closer to 1% is a lot better than it was earlier in the year when we didn't know if it was going to be able to get there. Our view is that there is a headwind from margin and interest rates that gets you into the back half of next year. I wouldn't say right now the banking industry is a revenue growth story. What's going to happen is that net charge-offs and non-performing assets, their peaks aren't going to be as high as we previously thought they were going to be. So that's why when you look at our stock selection, we're looking at Citigroup, Wells Fargo, Capital One, for example, which are big banks that have a chance to improve a lot on the credit side as we go forward. We think that's going to drive a lot of their earnings momentum. We don't think it becomes more of a revenue growth story until the back half of next year.
Is that going to be enough to power the stocks? You know, I just wonder, because this does seem to be a market where revenue growth, as you know, Tom, is what really seems to excite investors.
I do. And the reason being is it's where we started. It's first of all, I think that investors got so pessimistic on this group that the worst case scenario was baked in. Remember in the second quarter when there was talk about restricting dividends, 99% of the industry that we follow in our indices earned the dividend in the third quarter. We're getting the government stimulus that's necessary. I think there is enough, because what we'll do is we'll get return. The first step is to get a return to standard profitability, which hasn't happened yet, and that's going to drive a lot of earnings per share growth. We've got 20% earnings per share growth going into 2022 from 2021. That'll drive that. And then the second piece of the story, I think, will be a revenue growth story, which hopefully will layer in at the end of next year. And then we've also got consolidation, which I think is already started, and I think that's a big story for this industry.
Yeah, on the regional, I would obviously the mid-size and the regional level. We had a deal last week, a fairly sizable deal, right? Huntington.
Yeah, no, we actually, as a matter of fact, my firm's done 3 of the top 4 bank mergers of the year this year. I think next year is going to be a good year for consolidation. We're seeing PNC spend $11 billion to buy BBVA.
Right.
We also saw a big Midwestern bank last week deal with TCF Financial and Huntington coming together. The industry was consolidating pre-COVID. It's going to go back to it, we believe, again. But what's interesting is I think this time, David, it's going to be the bigger banks that are involved, which wasn't the case pre-COVID.
Interesting. All right, the bigger banks will be involved, well, not with each other, but doing some of these deals.
And let me tell you why, David.
We got a little bit of time, so you got to make it quick, Tom.
If PayPal were a bank, it'd be the second largest bank in America right now due to market cap. The banking industry is looking to get scale and to make sure that some of this permanent change in digital delivery stays in the banking industry. And that's what these mergers are all about, and which is why I think we're going to see more of them.
All right, we'll be staying tuned, and we'll turn to you as we always do, Tom. Thank you.
Happy holidays.
You too.
That really puts it in context.